get maimed, or their cars get messed up, or one of a litany of potential injuries. And that is a -10 for each of them. They crash. That's bad. Outcome. So when analyzing the outcomes of this game depends on the strategic choices by each of the drivers. It can be represented in a payoff matrix as we see below. Now, the Nash equilibrium. Nash equilibrium, you're going to hear that a lot in game theory. It's a solution concept in game theory where it represents a stable state where no player can unilaterally change their strategy to improve their payoff. So in this scenario, a possible Nash equilibrium is when both drivers choose to stop at the intersection, since no driver can gain a higher payoff by unilaterally changing their strategy without risking, death. So the Nash equilibrium is the first box, +5, +5. We both stop. Now, it gets into the question of this, if we were to really dig in, this is a cooperation versus self-interest kind of a question. The scenario highlights the tension between cooperation and self-interest. They're kind of interdependent, are they not? Right. So if both drivers cooperate and stop, they both benefit by avoiding a collision. However, if one driver decides to proceed without stopping, they can gain a higher payoff, but it's at the expense of the other driver. So in summary, this traffic situation exemplifies game theory by presenting a strategic interaction between these two drivers where the different possible strategies, whether that's to stop or proceed like a douchebag, these payoffs they are associated with strategies that are determined by individual choices, but they are interwoven, they're interdependent, and they determine the outcome, right? So each one of them effectively can determine the outcome of both of them. So it's important. Anyway, the concept of Nash equilibrium highlights the stable state of the game, and especially the decision for both of them to stop. So the scenario also emphasizes this kind of constant trade-off between cooperation and self-interest in decision-making. There's a lot of interesting research about why gas stations on adjacent corners will price relative to each other, because they can compete, but they beat each other up. Although if they cooperate, we're not calling it collusion, right? We're not the FCC but if a certain amount of cooperation is mutually beneficial, and there's some Nash equilibrium state, which also for the third party introduces that price competitiveness, reduces the decision-making possibilities you might have driving down and seeing the two gas stations and going, okay, this one I can get to, this one I can't. I might have to make it a weird U-turn, crash into 4 cars to get my gas, but I'll just go to this one. So there's another set of games that can be implied against those decisions. Every decision can be reduced to game theory if there's one or more individuals. Every decision. So when you start thinking in these terms, it's very interesting the way you might reanalyze basic situations. And traffic is a great one because we're all exposed to it all the time. So I like using it. I actually did a thought process of what is the game theory in dollar cost averaging, right? It's a different payoff matrix, but it is pretty interesting to kind of think about, right? So you have the players. Well, the player in the scenario are the individual investors participating in their market, right? In their investment market, whatever market it is. What are the strategies? Well, each investor could adopt different strategies when it comes to investing, such as lump sum investing or dollar cost averaging, right? Those are two different strategies. What are the payoffs? The payoffs in this scenario are the investment returns obtained by the investor over some specified time period. The longer you extend the time period, the better the returns are likely to be for the person dollar cost averaging. The returns can be positive or negative depending on market performance and chosen investment strategy. But some people buy at the bottom. Some people buy at the top. This is information you can't know till after the fact. So it's a known unknown, and you have to factor that, right? So what is the outcomes that you have to study? The outcome of this game depends on the strategies chosen by the investors and the market conditions. It can be, the guy that invested at the top of 2017 or the top of 2021 or the bottom of 2014, the bottom of 2019, maybe the bottom of 2023. So as you extend that time period out, you're going to see a lot of different performance numbers. What is the Nash equilibrium? Nash equilibrium might not apply directly in this scenario because it typically assumes a strategic interaction between players and you're competing just against yourself. But what you could do is you could say, the player one of me lump sum invests all my money. I punt all of it in today. Or the dollar cost averaging version of me invests over time. And you could compare those over time intervals and see how you did. And so anyway, game theory is still relevant though in analyzing these investing decisions because it makes the decision-making process and the expectations very clear, right? Well, we can't control market behavior, but we can control our behavior as we enter and exit a market. Does that make sense? Okay. Risk versus reward. So the concept of risk and reward is pretty significant in investment decisions, as I think you would all guess. Dollar cost averaging is often used as a strategy to mitigate risk. And so you do this by spreading investments over time and you reduce the impact of the market fluctuations. So you don't have to guess right. It takes the guessing out. It reduces the punting, right? Investors tend to weigh the potential rewards of lump sum investing against the risk of poor market timing, right? If you lump sum invest and you get it wrong, you could have many years of getting your ass handed to you. That's just depressing. If you wait long enough, you'll probably be fine, but I don't want to wait long enough. I don't want to get beat up for a 4-year cycle. I don't mind getting beat up for 2 years, but 4 years, come on, bro. Anyway, the stability of dollar cost averaging reduces so much emotional tension. Timing and market behavior. Game theory is a way to help us analyze how investors like ourselves may perceive market behavior and the potential strategies of other participants, the A and B of ourselves, right? So if investors anticipate that others will adopt a dollar cost averaging strategy during market downturns, they might adjust their own strategy accordingly to capitalize on potential price movements. If you see dollar cost averaging across the market, which you don't because people are not so smart, but if you did, you would see the market smooth. You don't see the market smooth because you don't see this behavior. So in summary, game theory can be relevant to the analysis of your own investment strategies, including lump sum investment, dollar cost averaging, just blind gambling, dart throwing, finding a trained circus monkey to choose assets. Like anyway, traditional game theory concepts like Nash equilibrium may not directly apply in this situation because you're just competing against your own portfolio, but the underlying principles and the strategic considerations, they influence your own personal decision-making. And markets are complex enough that you don't need to add an exogenous factor of guessing. Like you're already making so many guesses. You're already assuming so many things. Don't then add the guessing and assumptions of punting your money into the market and hoping that you pick the right day, the right month, week, or year. And so I think based on all of that, one thing that game theory has taught me is to reduce your emotions and smooth your decision-making. And the way to do that, to reduce the emotion in this market, is to have a dollar cost averaging strategy. And anyway, that was a derivative. But yeah, I would really think about how game theory is the fundamental, I don't know, like the very basic math, the algebra of decision making. And I think that's going to help you a lot. On that note, let's call it a day. Stay in school. Don't do drugs. Don't do anything my poor, insolvent, drunk, strung out on meth grandmother would not do. As you know, that is very, very little. I will see you tomorrow for digital heavyweights. For those of you that don't know what digital heavyweights are, well, aren't you lucky? Because I had AI record it for us. Do you want to get ahead? We have a program that really dives deep into investment management, game theory, cognitive bias, and the connection between cryptocurrencies, digital assets, and artificial intelligence investing. It's called Digital Heavyweights, and we do 3 private educational streams per week. You also get up-to-date news and research created by a team of writers and analysts that curate data from my personal investment portfolio. We do the heavy lifting for you. Join me and hang out with us Mondays, Wednesdays, and Fridays in the Digital Heavyweights. I'll admit that sounds marginally rednecky. I'm not sure why that is. I may have to re-record it. It's so rednecky, but whatever. Have fun with it. To tell you.